The economic consequences of the current level of interest rates are extremely serious, and the Fed will have an eye on this and be very concerned about it. So they've got this problem. How do they deal with it and inflation, the inflation problem at the same time? Now, I think that perhaps a consensus, with the US economy turning down, with inflation still continuing, et cetera, perhaps if they can sort of just muscle in a few cuts in interest rates, then consumers won't rush out and buy, sort of just put their money into goods and services and therefore drive up the prices quite so much. Perhaps a result of lower interest rates might end up taking a bit of inflationary pressure out of the steam out of the system. I can see them pushing that sort of argument, but it doesn't actually cut any ice. I mean, the person you want to listen to in America is Jamie Dimon. Dimon makes it quite clear that the outlook is very dangerous. He says he's pessimistic on the economy. And what this means is that the banks from the top downwards are restricting their lending. They cannot, in aggregate, cut their balance sheets. So what they're doing is they've diverted their lending from the private sector. And if you go around America and talk to small and medium-sized businesses and ask them about, the ability to borrow money from the banks, I mean, they will tell you in no uncertain terms, there ain't none. It's almost impossible. Instead, this money is being funneled into short-term T-bills, which has been basically funding the government's deficit. And the government, you've had, there's a headline, a couple of months back, that the government debt increased by $1 trillion in 90 days. It's a pace that is accelerating. But the reason that it's happening is because all the liquidity in the economy is tending to go away from the private sector into funding government spending, which is non-productive and inflationary. So the inflation dragon is actually still being fueled. On top of that, with the foreigners not buying dollars and at the margin selling, as we've seen with the Chinese central bank, with the People's Bank of China, then that means that the borrowing along the yield curve is going to get increasingly difficult. And you're going to see interest rates, bond yields, far higher out along that yield curve.
Alasdair Macleod continues his examination by delving into the structural issues within the gold market and the broader implications for the global economy. He emphasizes that the disconnect between the physical gold market and the paper gold market is becoming increasingly problematic. The banks, which have traditionally controlled the gold market through the creation of paper gold contracts, are finding it harder to maintain this control as physical gold supplies dwindle. Macleod explains that the physical gold market has been significantly drained due to high demand for delivery. This year alone, 253 tons of gold have been stood for delivery on the COMEX, a non-delivery market, which is an alarming indicator of physical gold being pulled out of the system. This trend is creating a crisis for the bullion banks that are short on gold, as they are unable to cover their positions with actual physical gold. The reduced open interest on the COMEX further highlights this issue, as it indicates a substantial reduction in the number of outstanding gold contracts. The situation is compounded by the significant level of savings in China, which has been increasingly funneled into gold. With a household savings rate of roughly 35% of GDP, equivalent to $6 trillion, Chinese citizens are moving their wealth into gold rather than traditional investments like property or stocks. This shift is driven by a lack of confidence in the financial system and the desire to preserve wealth in a stable and tangible asset. At current prices, this savings is equivalent to 75,000 tons of gold, a massive amount that underscores the potential for continued demand from China. Macleod notes that Western banks and financial institutions are fundamentally unprepared to deal with this shift. Banks are not in the business of holding physical assets. They are in the business of dealing with credit. As a result, they are reluctant to take delivery of gold to cover their short positions, preferring instead to close their positions. This reluctance has created a significant problem as the demand for physical gold continues to rise while the supply of paper gold contracts becomes less credible. The historical context is important to understand the current dynamics. In the past, bullion banks have been able to suppress gold prices by flooding the market with gold-denominated credit. This strategy worked as long as there was minimal demand for physical delivery. However, the game has changed as more market participants demand physical gold, thereby straining the ability of bullion banks to maintain their positions without substantial losses. Macleod also addresses the broader economic implications of these market dynamics. The shift towards gold as a safe haven asset reflects a growing lack of confidence in fiat currencies and the global financial system. As central banks continue to pursue policies that devalue currencies and inflate asset prices, individuals and institutions are increasingly turning to gold to protect their wealth. This trend is likely to continue, especially as geopolitical tensions and economic uncertainties persist. Moreover, Macleod highlights the role of interest rates in this scenario. The Federal Reserve and other central banks are caught in a difficult position. On one hand, they need to control inflation, which would typically require higher interest rates. On the other hand, raising interest rates too quickly could stifle economic growth and lead to a recession. This dilemma has led to a cautious approach, where central banks are hesitant to take aggressive action, thereby allowing inflation to persist and erode the value of currencies. In the context of these challenges, Macleod argues that gold remains a critical asset for preserving wealth. Unlike fiat currencies, gold is not subject to the same inflationary pressures and does not carry counterparty risk. As such, it provides a stable store of value in times of economic uncertainty. The ongoing demand for physical gold, particularly from large economies like China, underscores its importance as a hedge against financial instability. In conclusion, Alasdair Macleod provides a detailed and insightful analysis of the current state of the gold market and its implications for the global economy. He emphasizes the importance of understanding the disconnect between the physical and paper gold markets and the structural issues that are driving demand for physical gold. Macleod's insights suggest that the current economic policies are unsustainable and that individuals should consider protecting their wealth through tangible assets like gold. His analysis underscores the critical role of gold in maintaining financial stability amidst a backdrop of growing economic and geopolitical uncertainties.
Paper gold is credit, which you can create out of thin air if you're a bank. If you've got a banking license, you can create gold contracts, whether it's futures or forwards or whatever. The one thing you don't want to do is to take settlement. The swaps on COMEX have got themselves very, very short. And I'm sure that there are bullion banks in the same position in the London market as well, which of course is quite a bit larger. So it has been very much in their interest because they know what's going on. They've seen what's going on. They have been confused by it, but they now find that they are in a position of extreme danger with the physical stuff disappearing and the paper markets potentially losing control of the pricing. They want to close their positions down. And so consequently, they have moved very, very aggressively to do so. And if you look at the open interest on COMEX, it has virtually collapsed from something like 520,000 contracts down to, well, I think, last night we were looking at something like 430 odd thousand contracts, which taking it as an overbought, oversold indicator is very much an oversold indicator. So, and the structure of the market has also changed against the swaps. The swaps basically have, it's mostly comprised of bullion bank trading desks, but the producers are not hedging. In the past, when you had the spike up at 1900 back in 2011, 2012. The producers were short of 200,000 contracts, over 200,000 contracts. And that, if you like, meant that the short position in the market makers was not nearly as great as it is today. So they were able to hit the market very hard, and they drove the price down from 1900 down to something like 1,050 over a period of, 3 years. The swaps cannot do that today because the position in the producers is that they are net short of less than 50,000 contracts. The rest of the short side in the COMEX market is being borne by the swaps. And if you look at what's been going on over the last 2 or 3 years with stands to delivery in the COMEX market, this is effectively taking physical liquidity out of the market. I mean, huge tonnages are being taken out. This year so far, since January the 1st, up to last week, roughly 253 tons of gold had been stood for delivery. And this is a non-delivery market. Compare that with the annual output of America. The annual output of the United States is around about 167,000 tons. That's the estimate for this year. Already this year, 253 tons has been stood for delivery on COMEX. That is the extent of the draining. Now, the situation for the establishment is getting worse, and they are becoming aware of this. And that is because of the massive level of savings in China. At a household savings rate of roughly 35% of GDP, that's the equivalent of $6 trillion at current exchange rates. It's not going into property, it's not going into stocks, it's going into bank deposits, and increasingly it's going into gold. Now, $6 trillion is the equivalent of 75,000 tons of gold at current prices. I mean, the one thing that your Treasury Department in the bank will not permit is for you to load up on gold because, banks are not in the business of owning stuff. They're in the business of dealing in credit. And, if you've got a position, just close the bloody position. Don't go out and try and buy gold. So you can see that there is a hell of a problem which is built up over a long period of time through habit as much as anything else. I mean, the bullion banks have been able to control the market basically by flooding the market with gold-denominated credit. Whenever the buyers come in, it just takes the buyers out, buyers get tired, and then suddenly you bang it and you take out all their stops. I mean, it's a wonderful game, so long as nobody actually stands for delivery. That, however, has come to an end, and it's also coming to an end quite dramatically in silver.
Alasdair Macleod concludes his analysis by exploring the broader implications of the current economic policies and the critical role of gold and silver in preserving wealth amidst financial instability. He underscores that the disconnect between the physical and paper gold markets, coupled with excessive government borrowing and declining foreign demand for US dollars, is creating an unsustainable economic environment. Macleod highlights the importance of understanding the dynamics of the gold market. The significant reduction in open interest on the COMEX, from 520,000 contracts to around 430,000, indicates an oversold market. This trend, along with the substantial amount of gold being stood for delivery, signals a tightening in the physical gold supply. As more market participants demand physical delivery, the pressure on bullion banks to cover their short positions increases, creating a potential crisis in the paper gold market. The shift in gold ownership from Western institutions to Eastern buyers, particularly in China, is also significant. With a household savings rate of 35% of GDP, equivalent to $6 trillion, Chinese citizens are increasingly moving their wealth into gold. This trend reflects a lack of confidence in traditional financial assets and a preference for tangible, stable stores of value. At current prices, this savings is equivalent to 75,000 tons of gold, highlighting the scale of potential demand. Macleod points out that Western banks are ill-equipped to deal with this shift. They are not in the business of holding physical assets and are reluctant to take delivery of gold to cover their short positions. This reluctance creates a significant problem as the demand for physical gold continues to rise. The traditional strategy of suppressing gold prices through paper gold contracts is becoming less effective as more market participants demand physical delivery. The historical context is crucial to understanding these dynamics. In the past, bullion banks have been able to control the gold market by flooding it with gold-denominated credit. This strategy worked as long as there was minimal demand for physical delivery. However, the growing demand for physical gold is straining the ability of bullion banks to maintain their positions without substantial losses. Macleod also addresses the broader economic implications of these market dynamics. The shift towards gold and silver as safe haven assets reflects a growing lack of confidence in fiat currencies and the global financial system. As central banks continue to pursue policies that devalue currencies and inflate asset prices, individuals and institutions are increasingly turning to precious metals to protect their wealth. This trend is likely to continue, especially as geopolitical tensions and economic uncertainties persist. The role of interest rates in this scenario is also critical. The Federal Reserve and other central banks are caught in a difficult position. On one hand, they need to control inflation, which would typically require higher interest rates. On the other hand, raising interest rates too quickly could stifle economic growth and lead to a recession. This dilemma has led to a cautious approach, where central banks are hesitant to take aggressive action, thereby allowing inflation to persist and erode the value of currencies. Macleod argues that gold and silver remain essential assets for preserving wealth in this environment. Unlike fiat currencies, these metals are not subject to the same inflationary pressures and do not carry counterparty risk. As such, they provide a stable store of value in times of economic uncertainty. The ongoing demand for physical gold, particularly from large economies like China, underscores its importance as a hedge against financial instability. Furthermore, Macleod discusses the potential implications of central bank digital currencies, CBDCs. While CBDCs offer central banks unprecedented control over the financial system, they also pose significant risks to individual financial freedom and security. The introduction of CBDCs could lead to more intrusive financial policies, such as negative interest rates or automatic taxation, which could erode individual wealth and financial autonomy. In this context, holding tangible assets like gold and silver becomes even more critical. Macleod also emphasizes the importance of understanding the broader economic context and not being swayed by short-term market movements. The current economic environment, characterized by high debt levels, ongoing monetary easing, and geopolitical tensions, creates a favorable backdrop for gold and silver. These factors make precious metals an attractive investment for those looking to preserve wealth and hedge against economic uncertainty. If you want to stay most up-to-date on the silver and gold markets, make sure to subscribe to my daily 5-minute silver and gold newsletter. It provides the latest expert insights, breaking news, market trends, and investment strategies, all in a concise format. Click the first link in the description to join thousands of others and enhance your investment knowledge right now. If you enjoyed this video, please give it a thumbs up and subscribe to my channel. Your support helps me stay motivated to bring more valuable content to you. See you in the next video.